Every real estate cycle creates a window. A window where pricing disconnects from long-term fundamentals. A window where emotion and headlines overpower data. Dallas-Fort Worth is in that window right now. For the past 2 years, investors have heard one dominant narrative: oversupply, vacancy pressure, rent declines. And when investors hear those words, most pause. But cycles do not move in straight lines. They expand, they overshoot, they correct, they stabilize, and then they grow again. Right now, DFW is transitioning from oversupply toward stabilization. That transition phase is rarely comfortable. But historically, it's where disciplined capital positions. Let's start with the facts. Over 34,000 units were delivered into the DFW market. That's a significant wave of new supply. Vacancy climbed to roughly 12.4%. Rents declined about 2% year over year. Those numbers create concern, especially if viewed without context. But this wasn't a demand collapse. This was supply temporarily outpacing absorption. Developers responded aggressively to prior rent growth. Projects that broke ground in 2021 and 2022 delivered into a different capital markets environment. The result? Short-term pressure. But short-term pressure does not equal long-term impairment. That distinction matters. Now look beneath the surface. More than 23,000 units were absorbed over the past 12 months. That is not weak demand. DFW continues to experience strong population growth. Corporate relocations remain steady. Job growth remains diversified across sectors. Home prices have risen roughly 40% since 2019. That makes homeownership less accessible, which keeps renters renting longer. The demand engine in DFW did not shut down. It simply encountered a surge of new supply. Markets recalibrate. They don't break. Right now, we are in what I call the uncomfortable phase. Concessions are common, 6 to 8 weeks in many lease-ups. Luxury properties are competing aggressively. Vacancy in 4- and 5-star assets sits around 12%. 3-star properties are near 13%. Lease velocity has slowed. This is the part of the cycle where over-leveraged operators feel strain, short-term investors lose conviction, and weak hands exit. But this phase is temporary. And historically, it sets up the next opportunity window. Cycles reward patience, not panic. Now look at forward supply. Construction has dropped 25% year over year. The development pipeline has contracted rapidly. Only about 28,000 units remain under construction. That's the lowest pipeline since 2015. Think about that. Developers are pulling back. Lenders are more selective. Equity is more disciplined. New supply is slowing materially. Demand has not collapsed. When supply decelerates and demand holds steady, equilibrium follows. And equilibrium is where pricing power stabilizes. Looking forward, vacancy is expected to peak this year. In 2026, supply and demand begin moving toward balance. By 2027, rent growth is projected to return, modest but positive. This is not a rebound narrative. It's a normalization narrative. And normalization is often the phase where smart capital accumulates. Because by the time headlines turn optimistic, pricing has already adjusted. Positioning happens before optimism returns. Transaction volume tells an important story. Over $10 billion in sales this year. Up 37% year over year. Cap rates for institutional 4- and 5-star assets are in the mid to low 5% range. 3-star value-add assets are closer to 6%. REITs are re-emerging as net buyers. Institutional capital is not emotional. It studies cycles. It underwrites forward supply. It watches demographic trends. When sophisticated capital begins re-entering the market during uncertainty, it signals conviction. Smart capital is moving before stability becomes obvious. In every cycle, there are two types of investors. Type 1 buys when headlines are strong. When rent growth is visible. When vacancy is low. When everyone feels confident. Type 2 buys when fundamentals are improving, but sentiment is still cautious. Right now, DFW is not euphoric. It's not distressed. It's rebalancing. And rebalancing phases historically offer asymmetry. Limited downside once supply slows. Upside as rents normalize. That is the positioning window we are in. Let's simplify the pattern. Oversupply increases vacancy. Developers pull back, construction slows, vacancy peaks, rent growth stabilizes, value is created. This cycle is not unique. It's a familiar rhythm in real estate. The key is identifying where we are in that rhythm. Today, supply contraction is visible. Demand remains resilient. Vacancy appears near peak. That combination historically precedes stabilization. Step back from the short-term numbers. DFW remains one of the strongest structural growth markets in the United States. Consistent in migration, corporate relocations across industries, expanding suburban corridors, favorable business climate, employment diversity, infrastructure investment. These are not cyclical factors. They are structural drivers. The long-term thesis remains intact. Short-term oversupply does not erase long-term fundamentals. If you are an accredited investor evaluating capital preservation, institutional quality multifamily exposure, income with long-term upside, or strategic entry timing, this is not about chasing returns. It's about positioning within a cycle. Every allocation decision should align with your liquidity needs, your risk tolerance, your existing real estate exposure, your tax strategy. Cycles don't reward emotion, they reward discipline. If this phase aligns with your portfolio objectives, let's have a 15-minute strategy conversation. Not a sales pitch, a positioning discussion, because by the time recovery feels obvious, it's usually priced in.